There is a critical issue that haunts the balance sheets and future plans of countless businesses across the globe. It's a problem so pervasive yet so accepted as just the way things are that many people don't even question it. What is it? Paying rent. And that's what we're talking about today on Marcane Live. Every month, a substantial chunk of your hard earned business revenue vanishes before your very eyes. It's not going into new investments, it's not being saved for a rainy day, and it's definitely not funding your next big project. Instead, it's lining the pockets of your landlord, leaving you with little more than a thank you note in the form of a rent receipt and an expense line on your financials. So, have you ever stopped to calculate how much of your business potential is being compromised by the seamlessly ending cycle of lease payments? I know that we think of it as a normal part of doing business, but is it really? How does the traditional lease model really fail to serve the long-term interests of business operators today?
Yeah, I mean, from what we've seen, and again, I wanna sort of classify this, and this is really for businesses that are established and they're stable and they're growing. Generally, not brand new startup businesses. Obviously, need to focus on getting to the point where they're profitable. But for those that are stable, and the vast majority of them are, and they're growing, the lease it doesn't serve them primarily in a number of ways. And really kind of came to my attention through working with some of my clients early in the real estate finance world, where I would see and work with a lot of professionals and business owners that were generating a lot of cash. But as they were getting on in years, many of them had service based businesses, and yeah, they had great incomes, but a lot of them didn't have strong retirement plans. A lot of them didn't have a strong, asset base. And then they would look to sell their business, and there wasn't much there in the business when they decided to check out. Mostly just what we call goodwill, a customer base, and whatnot. And so there was a glaring loss of opportunity that most of these entrepreneurs were losing. And the silly thing is, it's one of these things. It's like you're walking on it every day. It's like it's right there beneath your feet, and most aren't thinking about it.
Yeah, it's so interesting. I talked to one gentleman as a guest on the show couple of years ago, where he had a flooring shop, and his first location, he actually felt like he just got absolutely raped by the landlord. To the
Mhm.
point where he decided that's it, I can't survive in this space anymore. And he went out and leased another location, but then he was so fearful of getting hoodwinked again that he actually went out to them and went to the banks and he actually purchased the business outright. And he
Mm.
really attributes that to the ability to successfully run that business for the last 25 years because he made that one decision.
Yeah, it's huge. It's huge, and there's a lot of hidden cost of leasing as well. You talking about, being sort of taken advantage of by the landlord. You sign a lease as a business for generally 3 years or 5 years or maybe more,
Mhm.
and as long as it suits the landlord's needs and purposes, that they'd be happy to renew when that time comes up, right? After you've spent your time focused on building your business and maybe a local clientele that's used to coming to that location. But if it doesn't suit their needs, then they may not renew, or they may raise the rent significantly. And we all know it's difficult to move. It's difficult to, I mean, heck, it's difficult to move your business bank accounts, for crying out loud, right? When you have all these transactions coming in, and then talking about moving your business itself, it's harder as your business gets larger. And so yeah, you lose all kinds of control, you lose some leverage opportunities, and just a host of things. We had a client that owned a couple pizza shops. He was an immigrant, been here for 8 or 9 years. He's got two pizza shops. One of them in particular, he rented both of the spaces, and one of them in particular, he had, like, I think he invested around $80,000 in getting the kitchen built out. Now, mind you, it wasn't his building. It was doing leasehold improvements on somebody else's property, right?
Yep.
And his proper and so he could have his processes, his kitchen, and everything where it needs to be. So a few years into it, the landlord showed up one day and said, "Hey, I'm selling the building." So what do you do with the local pizza shop, right? It's not
Yeah.
like, you can just move next door conveniently and everyone follows. There's a lot involved in that, right?
Yeah, yeah,
So,
yeah.
so fortunately, we were able to help him negotiate with the landlord to actually buy the building. So they gave him the opportunity to do that, and he was able to buy it. And it was a very defensive situation, but sometimes that isn't going to be the case, right? It's going to
Right,
be like,
right.
hey, we're going to sell this, and they're going to put something else here, and good luck. It's been a nice relationship. What we see a lot of too, it's not just the sort of defensive or, sort of the negatives of paying rent. It's the opportunity cost that as a business owner you lose by paying all that rent, right? So I mean, you think about it in terms of what most people are familiar with. You think about your own personal home. Most people don't rent, their personal home after maybe, the first few years, maybe they're getting started in life, getting married or whatever. Okay, they're going to rent, maybe move around a little bit. But once you get established, one of the major goals for people is to buy the home, right? And why do you want to buy your home? Well, hey, you want to make your wife happy if you're married like me. But beyond that, you have control over the premises. You can build it out to however you like without having to ask permission, and so you can sort of gin up the best customer and employee experience. Every payment that you make on that property is contributing to the increase in equity. There's some tax advantages for buying your own property versus renting someone else's, and of course, the as you build equity in your home, it gives you the opportunity at some point to potentially move up to a larger home when your family gets larger. You may have struggled for your initial down payment, but now you've got this equity in your house because it's appreciated over time and you've paid down some of the principal mortgage over time. And so you can use that money to as a down payment for the next house, or you could use that equity in your house for other things like maybe starting a business or potentially sending a child to college. There's things you can leverage. And at the end of the day, when you look back over, 20, 30 years of paying on that house, you hopefully have a paid for home where you've continued to scale up and you have a substantial amount of equity that had you rented, you look back and hey, the same 20 or 30 years is going to pass. And on one hand, you have this asset that's worth something. On the other hand, you had a good time. It's just a memory, right? It's like, okay, it was been there, done that. And a great example is one of my clients, Kathy. She's a friend. She's an OBGYN. And her husband, Jim, he's a little crazy. He was a Navy SEAL. And so he's very, on things. And so he was on her to like, hey, you need to buy your building. So about 12, 13 years ago, they bought their building. And she since has paid it off, the practice. She was going to pay rent to somebody. She's paid off the building. But a funny thing happened, Mark. So about a year ago, maybe a year and a half now, one of these larger medical groups who sort of buys up the small practices, as they build their larger enterprises, approached her to buy her practice. She's thinking, "Hey, I want to retire in a few years anyway." So she inked a very nice deal, sold her the practice. They allowed her to continue to stay on as a physician for as long as she wants, and which is not that long, but long enough. So she got a payout for selling the business. She, gets to continue to work on basically on her terms in the business. And, oh, by the way, since it's a local business and the patients are used to coming to that building, the new owner said, "Well, why don't we just rent the building from you?" So now she's got this amazing, retirement cash flow, a nice five-figure monthly payment coming in every single month, whether she ever does another mammogram or not in her life. And or she could sell the building if she choose to, if she wanted to lump sum for some reason, maybe she wanted to move to, Puerto Rico or whatnot. But so she has options, and those 12 years would have passed either way. Here's my take on the deal. It's like I think business owners, and particularly business owners that are locally based, that have
Mhm.
an impact and influence locally with their employees, their customers, their families. The those people, we're the backbone of this country, right? I mean,
Absolutely.
and
For
we're the
both
ones that do the
countries.
influence. Yeah, right, right, absolutely. Of the free world. Let's just put
There
it
you
that way.
go.
That
There you
we're
go.
the we're the ones that really create opportunity. We're the ones that can set culture, and we're the ones that have an impact day to day, more so than governments and whatnot, I think, because it's day to day. So I think, it's important to be successful as an entrepreneur, and it's important to be long term, and it's important to plant your roots and go deep. And that's why I think this is something that's really important for everyone to consider, whether the timing is right now or not, but at least at some point in your future should consider, because you need to own it. You need to be that influencer. You need to be somebody that's planted the flag and say, we're here, we're going to make a difference, and we're here for the long run.
And I believe, Paul, that have a bonus for the listeners. You mentioned something about they can get your book for free if they pay for shipping.
Absolutely. If you go
That's
to ownyourbuildingnow.com, they can pick it up right there.
now, as a operator, like for what you do, you have certain processes that you kind of hang your flag on, that you kind of help remove the stress, the uncertainty, and the fear in making the transition. Could you dig a little bit deeper into how you make that happen?
Yeah, yeah, absolutely. So, again, just as piggybacking on what we were talking about just a little while ago, there's a lot that goes into the process, and the more the more due diligence, to use your term, that we do upfront with the individual borrower, the business owner, the easier and the less stressful the process is. So I believe the military, I don't know if they still do it, but I know they used to do something called dry firing, where they would train someone to shoot a rifle with no bullets, because people, when they fear the explosion of the bullet, coming out of the barrel, it causes them to reflexively jump back. And so when they're waiting for that explosion, then it's hard to stay focused on the mark. And so, they taught people without pressure, knowing that it wasn't gonna, with no bullets, there's no explosion, there's no reaction. You learn to focus and breathe and do what you need to do. And so our philosophy is very similar. As I said, we start with the 53 question questionnaire to uncover the current state of the business, what the future goals of the business are, and some of the potential roadblocks and potholes along the way that we could encounter. And from there, we generally will connect up with the business owner's accountant and CPA directly with their permission. So we can take a lot of the heavy lifting off of, like, gathering docs and things like that from the business owner, so they could stay focused in their lane. And so once we understand sort of the present state of the business, where their future goals are, potential issues, and the financial picture, then we have some deep dive conversations in terms of options that are available in the market, in terms of different loan programs, different loan types. So we work with, gosh, I think 100 different investors plus that have different types of programs, and based on the specific business types, based on the specific building type, because there are different classes, based on how much down payment or equity injection the business owner wants to put in or can put in. And any, what I call hair on the deal, like maybe there's a credit issue or a background issue that we need to address, and some investors are okay with that, some aren't. And so from there, we build sort of an option board to educate that borrower. And this is in advance of going out and looking at property. I mean, you might have a sense of, kind of what you want, but we really suggest this before, going into contract or anything. So, how much building you can afford, what does it look like? And then at that point, then we suggest partnering up with a great commercial real estate agent, whether we could either recommend one, or if you have one, because now they know the specific market, they know the types of properties, and then we basically team up with them with what we know or we understand, and the options and opportunities, and have them to understand the market, to present options that might make sense. And a lot of commercial real estate agents, the really good ones, they know the market, and it's not like commercial's not like residential, where you're going to go on Zillow and find properties. A lot of them aren't listed. I mean, you have sites like LoopNet and things like that that will list, but not all of them are listed. And so the commercial real estate world is more of almost like a good old boys network, where there's girls too, but they know each other. Smaller communities are tighter, and they generally work together pretty well. And so at that point, now you've got, what you can afford, the different loan program options. Now you've got the realtor involved that's looking to fit in this realm. And then at that point, you can feel confident. And so So now you're basically ready because any of the issues that maybe we've identified in the preliminary options, we've either fixed them, solved them, or put together a plan to address those well in advance. Um, like, and there's a list of things too. You talked about like what are potential potholes and things that you have to discuss. Like one of the things we discussed early on is, hey, if you're married, is your spouse on board? Right? Because, your spouse may not be paying for the building, but, your spouse is gonna have something to say about it, and the last thing I've seen this happen before is that you get a you get a business owner, particularly a guy that's like, he's doing everything on his own, and then all of a sudden, the particular loan that he chooses or the bank puts him in requires his wife to sign as a guarantor, and she doesn't know this until the day of closing or the day before closing, and, Vesuvius goes off, and rightfully so, right? So things like that you're gonna address up front. The different covenants that you get into, like some banks and lenders will want to review your financials every year after you're in the loan. They wanna make sure it's performing, your business is still performing. So that's could be problematic, and some don't require um, some will require you to take a lien on your personal home. So, based upon the equity position, they're like, well, if you have equity in your house, we're gonna go ahead and put a lien there. You can still sell your house, but if something goes south, we have a right to that. So there's ways to avoid that and mitigate that, but you got to know in advance and you got to sort of know what you're going to do. The deposit thing we already talked about. Most of the local banks, and if we work with any bank at all, it's a local community bank. We don't do much with the big banks. They're really not for the small business people. But but the local banks, they're going to want your deposits, and so you got to feel comfortable. Again, putting your all your eggs in one basket, um, and so at least know going in what you're up against. And a lot of times we recommend a bank, based on the situation. And then the biggest thing is just being untruthful or not necessarily intentionally being untruthful, but you don't know if you're not asked the question, a lot of times you don't think about it, and that's why we try to start up front with our questionnaire to uncover the dirt, um, because it's so much easier to deal with upfront than later in the process, and because first impressions really matter, and banks and lenders, they look at a lot of deals, and if you look at the numbers, the percentages are in the 20 to 30% range of what they approve, and most of them, if they don't get, and this kinda goes back to the DIY guys, if they don't get like a complete package with everything they want up front, if something kinda smells, then what they do is they put it on the back burner, and it's just not they're just not that interested in it anymore. And so, anyway, so these are some of the things that we do.